Hello, everyone, and welcome to The Buck Stops Here. I'm Catherine Murray. Well, we've actually seen quite good equity market performance on a year-to-date basis, and I think that the earnings results so far have been much better than feared. At the same time, there's still a lot of unknowns and uncertainties surrounding the U.S. Federal Reserve. What will they do next meeting? We, of course, just learned that they raised rates by 25 basis points. Market kind of sold off, though. There's a little bit of a concern that they might keep going, might tip us into a recession or more of a recession. Maybe there will be stagflation. In other words, there's a lot of unknowns out there. And of course, that translates into what we see in the Canadian economy and the Canadian market as well. So let's get some perspective in terms of where we stand right now as it relates to the risks and the opportunities on the economy and also, of course, in the markets. And that means your RSPs and your TFSAs and your pension funds as well. So for that, let's now bring in Chance Finucane. He is the Chief Investment Officer at Oxbow Advisors. Chance, great to be with you. It was a long opening, longer than I normally do. I forgot to add in that we actually also had a bank failure. But let's start top down from your perspective, and let's start with the U.S. Federal Reserve's decision this week to raise rates by 25 basis points. What does that mean to you, and what should it mean for our viewers?
Sure. So I really don't think the 25 basis point hike by the Federal Reserve yesterday was a surprise to anyone. It's been a month or two now that investors have expected that they were going to hike one more time and then pause at this level of 5 to 5.25%. So we think that was baked into valuations already in the market. What we think is important, though, is they're still tightening, even though we're already seeing signs of slowing economic growth. And even though they're going to pause with the rate hikes at this level, they're still doing quantitative tightening, which means they're running off the balance sheet with some of the Treasuries and the mortgage-backed securities that they purchased earlier in the pandemic. That still reduces the money supply that's out there in the system. And right now we've got a 4% decline in money supply in the United States. And if you adjust that for inflation, it's a 9% decline versus the same time last year. We've never seen numbers that negative going back a century, which just makes it difficult for financial valuations to continue appreciating higher. So even though Jay Powell said yesterday he thinks the banking system looks solid and is intact, like you said, we just had our third out of the four largest bank failures in U.S. history have all happened in the last 2 months. So we think there's more weakness there than they want to admit, but they're a bit stuck because they need to worry about inflation still. And so they're hoping they can keep rates high for as long as possible.
Okay, there's a lot there and a lot to unpack. I want to just have you expand a little bit more in terms of why the money supply leads to the risk of lower valuations. In other words, stocks going down.
Sure. So normally the money supply grows about 6% a year if you're looking over the course of past decades. And that sort of growth money needs to go somewhere, and you tend to see some of it move into financial assets. And I think that was a big driver. You saw this huge spike in money supply in 2020 and 2021, where you were seeing 20% growth or higher year over year. And that's where you saw a bit of an asset valuation bubble, especially in companies that had no cash flow, no earnings. Same thing with cryptocurrencies. Now you're seeing the fallout of that, where they're trying to pull the money supply back down, and it's going to have an opposite effect of all of the speculative fervor that we saw in 2020 and 21. So when we see that sort of thing happening, we just want to make sure that we're focused more on protecting our clients' assets rather than trying to be aggressive and generate appreciation, because right now we don't think that's the right mindset to have. It's better to maintain more of a defensive stance.
Very interesting. With respect to Fed Chair Jerome Powell, it was interesting to hear him say, but he sees more data than I do, that's for sure, that the banking system is very stable. Do you agree with that? And there's the regional banks and then there's the big banks. And, you know, there is a view out there for sure that we will see many more regional bank failures. That doesn't mean the banking system fails, but it does mean that there could be increased volatility. What do you say to that?
I agree with you about the increased volatility. So the U.S. banking system is different from what you see in Canada, where there's just a small number of large banks that oversee much of the assets up there. Whereas in the U.S., you have a lot of regional banks that do a lot of small business lending and things like that. And we're seeing a shift now where it's more of the top four systemically important banks that are increasing their assets. And we
Right.
would consider that shift to continue.
So, Chance, I just want to pick up on something that you mentioned that I think is important to understand as it relates to regional banks failing. If I've got my numbers right, I think there's about 4,000 regional banks in the United States. And then you've got your big money center banks like the Bank of America, JP Morgan, et cetera. And in Canada, we have 5 to 6 large banks. It's a very different system and very different versus everywhere else in the world, quite frankly. But you bring up a really interesting point, which is that the small banks in the United States do so much of the actual business lending and the commercial lending. And so if you're a lending officer at one of these small banks and you want to make sure you keep your job, what are you doing and what aren't you doing? You're probably not lending. So if you believe that that is the case, what does that really mean in terms of the economic impact? Because what happens in the United States has a trickle down effect to what happens in Canada. Like, does it really halt economic growth is what I'm asking.
We would say it does. So just to take a step back, these smaller banks, when you have a period of economic growth, everyone focuses on the mega cap businesses out there, but especially in the US, most of the new jobs that are added in the economy during a period of growth come from small businesses. And small businesses get most of their loans to try and finance their growth plans through the smaller banks. The smaller banks, the difference between them versus the JP Morgans and Bank of Americas of the world is that they have a higher loan to deposit ratio. So the customer deposits that they have at their bank, they're turning around and making a greater percentage of those deposits they're putting into loans, primarily towards small businesses. And with what's going on right now, where you're getting a 5% interest rate, you're seeing more customers at banks trying to pull those deposits and say, oh, I can get 5% somewhere else if you're not going to give me a 5% interest rate for what I've got with you at the bank. So because of that, some of these smaller banks are unsure what their deposit levels are going to stabilize at. And if they don't know what their deposit level is, they don't want to overlend and all of a sudden have more loans out than they have deposits. So they're really pulling back on their lending, but that means that there's a whole section of the business environment that's going to slow down because they're not able to get loans. And we hear stories from various people that Ted Oakley and I and others of our team speak to that just tell you anecdotally that this is happening in the last month or two. And you see that with some of the survey data that the tightening lending standards, both in the US and in Europe, are at levels you normally only see in recessions. So that's why even though you've got the large cap stock indexes are still trading at higher levels, we would say that's a bit more of a mirage and we'd rather stay cautious.
Interesting. And just to add on that, what I find interesting as well that I've been thinking a lot about, as you say, a lot of people are taking their money out of the bank and putting it into something yielding 5% and something that has, somewhat on the risk-free rate side, plus a bit of risk. But even if you take a look at Treasuries, if a lot of people have been moving their money into Treasuries, my concern is that that's been such a trend trade that I'm concerned personally to do that trade because I think that the opposite could have an effect in terms of, I just think there's almost too much risk in that risk-free trade. Does that make sense?
Yeah, it's right to sort of consider if it's become too popular. One thing that we pay attention to, especially with longer term treasury bonds, so 10-year treasuries or 30-year treasuries that can move the market, is look at the speculative accounts, where they're situated, if they're short long-term treasuries or if they're long in the long-term treasury bonds. And right now you actually are seeing the speculative accounts, which is sort of the non-commercial money, looking very short, which typically can drive bond prices higher and yields lower. Now, it depends on your time horizon. Right now, we're seeing some strength in the treasury bond market and yields are moving down. So while we've been buying treasury bonds for accounts over recent months, we might wait for a little bit of a short-term pullback before we add more. But we do think this trend, when you have more of a slowing economy and falling inflation, tends to be a good environment for treasury bonds. And so we think that trend will continue where yields move down. That's a separate question from the very long term, where we might be in an environment where long-term Treasury yields might be moving higher in the years to come. But in this current environment with growth slowing, we would say to keep an eye out for yields continuing to move lower in the months or quarters to come.
Okay, and just before we wrap this segment, do you think that the Fed will end up cutting rates this year, or is that a 2024 thing, or do they at all? Because Fed chair said basically they're not going to do it. Okay, 7 seconds.
They could. We'll just have to see.
So, Chance, it sounds as though then, I mean, your base case, your fundamental view right now is really more on the cautious side. Can you give a few more examples, economic data, because I think it has been very mixed as of late. There has been a way to make the bull and the bear case. There's been no doubt about it. But I do think more recently we are seeing some slowing down effects. But PCE is still relatively high. In other words, we're still seeing inflation, and now you're seeing more people talk about stagflation, even though that was put in the back burner going back a couple of months ago. But give us a few more examples, economic data-wise, that make you concerned.
Yeah, just to touch on the PCE inflation that you mentioned, that core PCE number is one that the Fed has said they pay attention to. And Chairman Powell has said that he does not want to start cutting rates until all of the different Treasury yields are trading at a level below that core PCE. Well, right now, core PCE is still near 5%, and you've got the 10-year Treasury yield under 3.5%. So he needs to see that come down more before he'd really want to look to cut. So just to follow up on that last segment, I think they're going to try and wait as long as possible before they have to cut. And maybe a furthering of this regional bank crisis could force their hand, but I really think they don't want to do that unless they absolutely have to. In terms of metrics that are more cyclical that we pay attention to, it's just the ways you can tell if there's strength in the financial markets and in the economy that point to an acceleration in things, and it's time to be more aggressive. So this could be like looking at emerging markets compared to other developed markets around the world, or looking at the Dow Transports Index versus the Dow Utilities Index. You could look at what's happening with Treasury yields. You could look at the performance of currencies of countries that have a lot of commodity business, so Canada, Australia, New Zealand. Compare that to more defensive currencies like Switzerland and Japanese yen. These are all areas where you're actually seeing a deterioration in the cyclical side and strength in the last 2 or 3 months on the defensive side. You could also look at large cap versus small caps, financials. Small caps and financials have been weak now for several months. So when we look at that, this doesn't tell us that that low that we made in the market back in October of last year was a great low to buy and hold for multiple years. It suggests to us that that might have been a short-term rally, but we need to keep an eye on further deterioration or negative news on the horizon.
It's interesting. You used the word mirage earlier, and most of our viewers know that I spent my time on Wall Street, and I was on the sell side. And the sell side people are always the glass half full people. So I tend to be quite optimistic when I look at the markets. Realistic but optimistic. But I have to say, I'm pretty surprised that the market has been this resilient. I feel like it's almost too resilient for what I see out there. What would you say to that?
Yeah, I think there's a makeup of the market, especially if you look at U.S. large cap stocks. So the strength in the NASDAQ or in the S&P 500. In the S&P, for instance, half of the return that we've had this year has come from 3 stocks. It's Apple, Microsoft, and NVIDIA. And the excitement around the development of generative AI and what that could mean, obviously is very exciting, but it's so early. You don't even really know what the potential of that is and where that could go. So we would say that the speculation that's driving prices higher has gotten ahead of the fundamentals. And while that's great for anyone who's owned those positions, it's not something that we would be chasing and trying to buy at these prices. And then if you're looking at other cyclical sectors, even though you've got an overall market that's trading at 18 times earnings, which is above average, you've got other cyclical sectors that tend to fall down during a recession. They're starting to weaken. So financials, industrials, energy, materials, excluding gold, those are all starting to break down and suggest to us that this weakness could continue. But when we look at the valuations, they still say that they're only about fairly valued. They're not really cheap yet.
Mm-hmm. When you take a look at energy and the weakness that we've seen this week, why do you think it weakened on the back of the Fed yesterday?
There's so many inputs into the oil market. I don't know that that would be the one thing. I think what we focus on with something like the oil price is just the overall economic trend. And if you're just going back through decades of history, when you have a recession, which is what we think is still on the horizon, the oil price tends to go down and you don't really want to own volatile energy stocks in your equity portfolios. You want to wait that out. So we would just say to continue to stay defensive on that and expect the price to continue to be weak for a little bit longer.
Yeah, to me, it was a read through that the market is concerned about the Fed and that we'll see a significant recession. Chance, with everything having been said in terms of, some solid reasons as why we should be defensive in our portfolio approach right now, what does that mean in terms of where you are putting money to work? How do you invest in this scenario?
Right now, what we're looking, so just as an example, David Rosenberg's team up in Canada did some great research. They looked at the leading economic indicators, which are down 8% year over year, which usually is a sign that we're heading into a recession in the United States. And what asset classes do well over the next 12 months over that period, and which ones do not do well. And just looking at that research in past examples like this, it's defensive sectors in the stock market, so consumer staples, healthcare, utilities. It's also looking at treasuries of any maturity, so 2-year treasuries, 10-year treasuries, 30-year. That works because at some point the Fed's hand will probably be forced to start cutting rates, which will help the 2-year treasury go down in yield and the price will go up. And then at the long end of the treasury curve, just the slowdown in economic growth, you'll see some continued appreciation in the prices of treasury bonds. So we have the majority of our clients' assets right now sitting in short-term treasuries and then a little bit in long-term treasuries to try and take advantage of that and just be able to get some yield, especially when you're looking at a 4 or 5% yield at the short end. That's pretty attractive. Beyond that, we've owned gold for several months as well, and that's performed well and might take a bit of a breather here, but we still think that's an area that tends to do well in this sort of environment.
And then with respect to the equity portion of the portfolio, can you talk to us about a couple of stocks that might be interesting or defensive in this market?
Yeah, so when you're looking at consumer staples and healthcare, consumer staples really have relatively been strong recently, so there's not a lot of value there. On the healthcare side, you're still seeing a little bit. So U.S. health insurers had a pullback in the first quarter, and so we were adding Humana and Centene. We've owned Elevance Health and United Health for some time already. Those names, I think, there's always concern around regulatory policy in the United States, but those tend to be pretty consistent businesses that have good visibility on their cash flows and are a good thing to own in this sort of environment. Beyond that, we're actually seeing some opportunities in pretty defensive areas of the market that don't grow a lot, but are delivering 6 or 7% dividend yields and are trading at lower valuations than their history. So that would be some of the oil pipelines, which don't fluctuate as much based off the oil price. It's more just the cash flows from the volume running through their system. So that would be like Enterprise Products, Kinder Morgan, or Magellan. Those are all trading with high dividend yields. And then you also have the networks, Verizon Wireless and AT&T are trading with 6.5 or 7% dividend yields and trading at low valuations. And while we don't expect much growth there, we don't think we'd want to own that for 5 or 10 years. At these levels, it's a decent place to be while you kind of wait out to see if you get some cheaper valuations in the more cyclical sectors in the months or quarters to come.
Full disclosure, I actually bought AT&T because of the low valuation and the high dividend yield, and then it went down. It's like, but I hear you. I bought it for those reasons.
Mm-hmm. Yeah, it's tough. I think we've had to adjust what dividend yield is the right entry point, because for years there, when interest rates were so low, a 5% dividend yield was great if you're looking for a common stock or a preferred stock. Now we're almost looking at 6% or higher, even 7% before we would really want to move in, just because the competition against a 4 or 5% treasury yield, you need to see a significantly higher dividend yield in order to consider that's attractive.
Yeah, no, that makes sense. And people have to remember too, sometimes a high dividend yield signals that there's more risk in the stock. But real quick here, Apple's going to be reporting today after the closing bells. Just quick thoughts if that's, a buy and a hold for the foreseeable future.
We think it's trading above its fair value, probably by about 20% right now. It's one that we've owned for probably close to a decade for our longtime equity clients, and we've just held those gains. We've tried to trim in retirement accounts because sometimes when it runs ahead of itself, we think it's worth doing that. But right now, Apple still generates a ton of cash flow. We think they're going to report another negative quarter. The key is, can they return to growth in the next quarter or two in revenue and earnings per share? That's what's expected, although they might have a difficult time following through on that.
Okay, Chance, we got to leave it there. Great to have you. We covered a lot. So thank you. And thank you, everybody, for watching. We'll see you next time.
If you like this video and want to stay up to date on our views about the financial markets, please subscribe below to our Oxbow Advisors channel.